This is called Financing Smallholder Agriculture, an experiment with agent-intermediated microloans in India. And this is joint work with Pushkar Maitra, Shundeep Mitra, Dilip Mukherjee, and Alberto Motta. And I also want to acknowledge all our funders, including the Hong Kong Research Grants Council. Okay, so let me just dive in. The broad question that we are interested in here is studying how we can provide finance to poor farmers. So that's the broad question that motivates this research, because we know from a lot of literature that institutional finance does not typically reach smallholder agriculturalists. The reasons for this are that institutional financial providers have poor information about the creditworthiness of the borrowers they are trying to lend to, and also have limited capacity to enforce the repayment of these loans. These smallholders typically do not have collateral to post, which makes it hard to enforce that they repay, and also these loans tend to be very small, so that the transactions costs per loan tend to be very high. As a result of this, we think that poor farmers tend to rely on informal lenders for credit, and that this informal credit comes at a high cost. This could be either because lenders are capacity constrained, or it could be because lenders are usurious. They're monopolists, let's say, and they're trying to maximize their profits, and they charge very high interest rates. But either way, what it tends to create is a problem of credit constraints. So poor farmers tend to be credit constrained. They typically have less credit, access to less credit than would be what as economists we would call socially efficient, which prevents them from diversifying into high-value cash crops, and in turn restricts agricultural growth in developing countries. So a major development challenge is something, this is something that a lot of people have been working on, is to understand if financial institutions can lend profitably to productive small farmers. Now, a lot of people might think that, a lot of us think that microcredit may solve this problem. Microcredit famously has increased access, credit access for the poor. However, it has not successfully promoted entrepreneurship, risk-taking, and borrower incomes, as recent experimental evidence seems to have shown. This is a controversial finding, and there's a literature in economics in microcredit that argues that in Bangladesh it might have improved borrower incomes, but I think more recent evidence, experimental evidence, suggests that it has not. Okay. Also, microcredit typically does not finance agricultural working capital. Okay. Why not? Well, because traditional microcredit is motivated by the need to ensure high repayment rates. So this is the big innovation of microcredit, that we can now lend to people who are unable to post collateral, and we can do this in a financially sustainable way. So how do we do this in a financially sustainable way? It is by ensuring that they all repay their loans, okay, or that the repayment rates are very high. And so given that it is motivated by the need to ensure high repayment rates, repayments tend to be required at high frequencies. Okay, so weekly, fortnightly, or monthly repayments, and there also tends to be intensive peer monitoring. The reason for peer monitoring is that these loans are often given in two groups, right? So groups are jointly liable for these loans, and so then these group members also have the incentive to monitor each other. This is a good thing because it discourages borrowers from investing these loans into projects that are too risky, right? Also, MFI officials themselves monitor these borrowers as well. All of this is good because it limits risk-taking, which in turn ensures that repayment rates are high, but then it also rules out the scope for financing agriculture. Because agriculture, first of all, has long crop cycles, so that you're unlikely to be able to repay at a weekly frequency. And also, agriculture tends to be high risk. Okay. So the question that we are thinking about here is there an inevitable trade-off between selection and repayment incentives and financing productive and risky activities? Can you do only one or the other? Yes?
So this earlier result that you report that questions whether microfinance is delivering these benefits in terms of entrepreneurship, et cetera, is that specific to the traditional microcredit model?
Yes.
Or, I mean, there must be some studies showing positive effects, right?
There are
So
some
what's
studies.
the claim here, that non-result claim?
I think all of the ones that I cite here are looking at group-based lending. So it's all group liability with the weekly, yes, or fortnightly repayment, yes. And they're claiming that that does not increase incomes. I'm not aware of people who have studied. So we are changing a lot of things, including this. There are some people who have looked at individual liability loans, but there may be some studies that argue that individual liability does better than group liability. But I don't think anybody has experimented with the whole package that we are working on here. Okay. So is this an inevitable trade-off, or is it possible to design an alternative lending mechanism that is able to finance productive and risky activities and at the same time ensures appropriate borrower selection and repayment incentives and is cost effective for lending institutions? Now, everything I'm going to talk about today is really about borrower selection, repayment incentives, and creating impacts on borrower incomes. I'm not really going to talk about the cost effectiveness of this lending approach, but that is something we're thinking a lot about as well, and I'm happy to talk about it if there's time at the end. Okay, so what we do here is we design and implement experimentally a new approach to financing smallholder agriculture, where loans have certain features that encourage their use for cultivation, basically, and this is a list of those features. So in the context that we are doing this, crop cycles tend to be 4 month long, and so the durations of the loans are 4 months. Repayments are due in single lump sums. Insurance, there is built-in crop insurance. The lenders do not monitor the borrowers very much. The interest rate that we charge, or that the microfinance institution charges, is lower than the market informal rate. And also there are dynamic repayment incentives, meaning that if a borrower repays this loan successfully, then he or she is eligible to receive a larger loan in a future cycle. Okay. Importantly, we induce borrower selection by appointing a local intermediary who is basically either a shopkeeper or a trader, typically in this village, to recommend borrowers to the microlender. Okay? So we get rid of, the idea here is we get rid of, I should say this, yes. So these are individual liability loans. So we get rid of the group-based feature of microcredit. But the group-based feature, as we know from the literature, is also important in that it induces a particular kind of selection into who borrows from microfinance institutions. So when we get rid of the group-based feature, we don't want to get rid of this borrower selection, so we replace it with this alternative, which is, like I said, a local intermediary who is asked to recommend borrowers to the microfinance institution. Okay? So we call this whole package the Trader Agent Intermediated Lending Scheme, or for short, the TRAIL scheme. And then what we do is we conduct a field experiment to evaluate this TRAIL scheme in comparison to a group-based scheme, okay? Where the group-based scheme is much more similar to what I described traditional microcredit as being. However, it is modified in some ways. So it has the same features to encourage loan use in agriculture as the TRAIL scheme, okay? Meaning that it has a longer loan duration, single repayment, crop insurance, et cetera, but it also has traditional group lending features, which is self-forming 5-member groups, monthly group meetings, all members have to meet savings targets, and the loans are given with joint liability. So the entire group is jointly liable for repaying this loan, unlike the TRAIL scheme where, like I showed you, these loans are individual liability. Okay. So, by the way, I'm happy to answer other questions as well if anybody has any. So we collaborated with a microlender in 2 potato growing districts in the state of West Bengal, which is in eastern India, to introduce the TRAIL scheme in 24 randomly chosen villages and the GBL scheme in another 24 randomly selected villages. And what I will talk about today are the impacts. We evaluate the impacts of these loans on the total borrowing of borrowers, their cultivation choices, how much output they produce, and value added they generate. And we separately examine the behavior of those selected to receive loans. So I'm going to be experimentally, we're going to try and separate the impacts from the question of who gets selected to receive these loans. Okay, and this will become clear when I talk about the empirical analysis. Okay, now the agent obviously needs to be incentivized in order to do in order to select these borrowers in line with what we are hoping they will do. So the agent receives a commission, which is a fraction of the interest that is received by the microlender from the borrowers that this agent recommended. And in our experiment, this fraction was set at 75%. Okay? Plus, the agent also stands to gain a bonus, which is payable at the end of 2 years, conditional on satisfactory repayment by his recommended clients. Okay, now I should say that, you know, using the idea of using local intermediaries in order to recommend borrowers to a formal financing institution is not a completely novel idea. This has been done in other contexts. So it has been done in places, most famously in the Philippines, but also in Indonesia, Malaysia, and so on. And essentially, the literature on those experiments or on those policy experiments has basically shown that agents abuse the power that they have. Okay? So agents could do any of these things. Okay? They could select their cronies. They could select people who are willing to pay bribes in return for being recommended. They could select unprofitable clients, non-poor clients. They could charge additionally high interest rates, either if the scheme allowed them to do that, or they could demand kickbacks. They could manipulate other contractual relationships. They could recommend that borrowers not repay the loans, or they could force borrowers. They could coerce borrowers to repay the loans. Okay, so all of these things are potentially possible, and what I will show you on the next slide is how we designed the scheme in order to hopefully limit how much of this happens. Okay, so what we did was require that the client's job was only, sorry, the agent's job was only to recommend clients, not to actually do the lending. Okay, so the loan officials lend and collect payments from these borrowers. The rules of the scheme say that only landless and marginal landowners, which in our context is people with less than 1.5 acres of land, are eligible to borrow. The interest rate is pegged below the average informal market rate, and this is common knowledge to everybody in the village. The agent will forfeit his deposit if any client does not repay, so he pays a deposit per borrower that he recommends, which he loses if the client does not repay the loan. And if less than half of the loans are repaid in any cycle, then the agent is terminated. And also, not every household receives the loan. Okay, so from the list of borrowers that the agent recommends, there is only a randomly selected subset actually ends up receiving the loans from the scheme, from the microlender. Okay? And later, I will also show you, we do examine in the data, we try and examine if the borrower's benefits were extracted by manipulating other contractual relationships, and I will try and convince you that that did not happen. Okay, so we have a theoretical model where we try and understand whom the agent will recommend. Okay, so to understand that, we need to first think about what is the informal credit market in this village. So the way we model the informal credit market is that it is a segmented credit market. Okay. Each informal lender has a network of households that borrow from this informal lender, okay, with whom he also shares information about production and marketing, okay, and the entire network acts cooperatively to maximize aggregate profits. So you should think of a village as being made up of either connected borrowers who belong to a network or floating borrowers who belong to no network. And because the connected borrowers are connected and they have all these benefits that they get from being part of the network, we assume that their project succeeds with a higher probability, PC, compared to the probability of success for a floating borrower which is BF. Okay, so just to show you here, I made this picture to kind of help you think of the village. Okay, so you have these networks where you have lenders and you have all these connected borrowers in those networks, but then you also have these other floating borrowers. Okay? All right. So, like I said, Connected borrowers succeed more often, so their probability of success is larger. And it's not just larger than PF. We actually impose that it's larger than PF times 2 minus PF. That's going to be important when we look at the group-based loans. And then connected borrowers pay lower informal interest rates as well. Okay. Now, into this village, which has this informal credit market, imagine now that the trail scheme enters. Okay, so enter the trail scheme. The microlender is going to appoint one of these informal lenders as its agent. Okay, and ask this agent to recommend borrowers to the microlender. So the informal lender used to lend to these people, and now this microlender is going to come in and ask this person to recommend borrowers to the microlender so that the microlender can then lend to them. That's the idea. Okay? So the question is, whom does he recommend? And I always say he because the truth is all our agents are male. Okay? So whom does he recommend for the trail loans? Well, in the model we show that in terms of his strategy, it's better for him to recommend an own network borrower than it is to recommend an other network borrower, than it is to recommend a floating borrower. Okay, now I'm going to explain why. So remember that the network borrower, any network borrower, whether it's own network or other network, any person with the subscript C has a higher probability of success PC than PF, right? So a network borrower is more likely to repay than a floating borrower. Okay. So if suppose now let's just compare these two people. The other network borrower will generate a greater commission for the agent, right? Because the agent's commission depends on the repayment that you receive from this borrower. This borrower is more likely to repay, so the commission will be larger. So the other network borrower dominates the floating borrower. And then you could ask between the network, other network and own network, which one dominates? Well, the own network borrower chooses a loan size to maximize the entire network profit, okay, which includes the agent's commission. So the own network borrower is going to end up generating a higher profit for the agent as well. And so the agent will prefer to recommend an own network borrower instead of an other network borrower. Okay. Now let's look at the group-based lending scheme.
But Sujata, what is the payout to the informal lender?
The commission.
I understand that a network is going to maximize the joint surpluses in some sense, and they can coordinate between them. But
yeah.
But what is the payout of the agent or the informal lender?
The commission.
But previously he was lending to the same borrowers and probably making some money by lending, right? So doesn't the
so it's an assumption.
Crowd out?
Yes, it does. It does.
Taking his own business.
It does. It does. So I didn't say, but the commission needs to be large enough. The commission needs to be large enough for this to happen. If the commission is too small, then he will not. Yes, then what he loses out by not lending to this person is larger than what he benefits from recommending him. You're absolutely right. So it's important to get that K right.
Because otherwise it might make sense to go to the other network.
Yes, yes, yes. Yes, so if K is large enough, then this will be true. K is the commission rate. Okay. Okay. So group-based loans have lower interest rates than the average informal rate. We know this already because that's how the scheme was designed. And both connected and floating borrowers will apply for loans. Okay, so there's no mechanism in this scheme that prevents either type from borrowing, so that you could end up with homogeneous groups or you could end up with mixed groups. And the average GBL borrower, essentially the main point here is that floating borrowers will also apply for group-based, to participate in the group-based scheme. Okay? So that you end up in the trail loans, you only end up with connected borrowers. In the GBL loans, you also have these floating borrowers, so that the average GBL loan is less likely, average GBL borrower is less likely to be connected than the average trail borrower, as a result of which GBL borrowers have higher heterogeneity in productivity, and they pay on average a higher informal interest rate before these loans are given out. Okay? So, yes?
So, but for the group-based loans, they're going to self-select themselves into groups.
Yes. 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 Yes.
There is a network.
Yes. No. Yes. There is, but they're not. connected to the informal lender. So they could be internally connected. All the floating people could be part of a network, yes, a social network or some network, but they're less likely to be connected to the informal lender.
But, I mean, I guess if you're a floater and maybe you don't have a network, as you portrayed, then maybe...
Then you wouldn't even be here.
Maybe Grammy squeeze you out fine if you don't participate because you can't get 4 other people.
So that's also possible. Then there's another type. There's the floater, right? Then there's an F1 and an F2, and we don't get the F2s. You're right.
So the group is connected, but they don't know a lender.
Yes. Yes. The group could be connected, but they don't know. But they're not part of the informal. Yes. They're not part of the informal lenders network. They could be part of a social network. Absolutely. Yes. But since our model is only about the informal lenders credit market, they're not. They're floaters in our terminology. But like Albert said, there could be 2 types of floaters. Okay. Okay, so now I'm going to talk about the data. So we collect household survey data from 48 villages, 50 households in each village, every 4 months. Okay? And we get all of these data from these households, demographics, land holding, land use, assets, how much they cultivate, what inputs they use, and how much they harvest, sell, and store, and various other things. And we also get loan record data from the microlender, as well as, and we also have one-time village survey data. So first, to show you village level differences, that they are not significantly different from each other, these villages, in terms of certain village characteristics. You can see that only about 60% of households are electrified, 78% have primary schools, about a quarter have primary health centers, and a very small fraction, less than a fifth of them have bank branches. And here I'm showing you the differences in terms of household characteristics. Some things that are interesting, I actually show up on the next slide, I think, here. So in the period before we started our project, 70% of the households said that they borrowed, okay, and 60% of them had borrowed for agricultural purposes. You can see their average loan size is about 6,000 Indian rupees. And you can see that 65% of their loans come from informal lenders, okay, 65, 66. Government banks, so formal finance is very, very small. Okay. Cooperatives do lend, about a quarter of the loans come from cooperatives. And you can also see that interest rates vary a great deal depending on whom you are borrowing from. So government banks and cooperatives give significantly cheaper loans, but both of these types of loans tend to be collateralized. So you need to post collateral in order to receive them. Informal lenders charge higher interest rates on average. Okay. All right. Now the sample. So the sample is made up in the following way. In each village, the trail agent, so first I'm talking about the trail sample. In each village, the agent recommends a set of borrowers, and the lender is then going to offer the trail loans to a randomly chosen subset of these individuals. So those borrowers or those households are going to be called T, or treatment. But then there are going to be those borrowers who did not randomly get chosen to receive a loan. So they are going to be called control 1 borrowers. And then, of course, there are all the other persons in the village, households in the village, who didn't even get recommended. And so a subset of those are also in the sample, and they're called control 2. Okay. And then similarly, we have the group-based lending scheme. So in each village, individuals form groups and apply for loans, and the lender offers the group loans to a randomly chosen subset of groups. So those households become T. Then the groups that form but do not receive loans are control 1, and then there are all of those that do not form groups, and those, a subset of those are in control 2. So just to clarify, I think I said this before, but just in case it wasn't clear, there are no villages where both of these schemes are offered, right? So there are 24 villages where trail is offered, and there are 24 villages where GBL was offered, and there are no villages where nothing was offered. One per village. Yes, I should have said that. Only one per village.
And is there a limit to how many people they can recommend?
They are asked to recommend 30, and then 10 are randomly chosen here into treatment. The remaining 20 go into control 1.
So they cannot recommend more or less than 30. They have to provide 30 names.
Yes, they're asked to provide 30 names. I suppose they could recommend fewer, but I don't think we have any people who recommended fewer.
But then how do you select that people?
Oh, yes. So that's a good question. So there was a list of criteria. So we were looking for people who were intermediaries in the village. So they should have had a business that had been operating in the village for at least 3 years. They had to have at least 50 clients within the village. And we drew up a list of these individuals, and then one of them was randomly selected and was offered this job.
And they were already doing informal lending.
We didn't check that they were informal, they could have been traders or shopkeepers or informal lenders. Yes. A lot of traders also lend. So you can have, two businesses at the same time. Does that answer your question? Okay. Okay.
How about the typical size of the group lending?
Sorry?
How about the typical size of the group lending?
The loan or the size? Five members.
How many got treated in? What percentage?
Oh, two groups, so 10 people.
So for both treatments, you're treating a very small percentage of those villagers.
Yes. Yeah. Okay. Okay, so then we're trying to estimate treatment and selection effects by running a regression where we put in dummy variables for whether this is a trail village. So V subscript stands for village, I subscript stands for household. So trail village, trail interacted with being in control 1, trail interacted with being in the treatment group. Similarly, GBL interacted with being in the control group, and GBL interacted with being in the treatment group. So we can then estimate selection effects, which is the difference between beta 2 and beta 1, because this is picking up the effect of being control 2 in a trail village. This is the effect of being control 1 in a trail village. So the difference is the selection effect. Similarly for GBL, beta 4 minus beta 0. And then treatment effects are basically if you are recommended but don't get a loan versus you are recommended but you are also randomly chosen to get a loan. The difference between beta 3 and beta 2 should tell you the treatment effect for trail, and similarly for GBL. Okay. So now I'm going to start showing you the effects. So I show you here the selection effects as well as the treatment effects. So the first thing you note is that total borrowing increased as a result. So this is, by the way, we did this for, I think, 8 cycles. I'm showing you data from 3 cycles. Okay, sorry, showing you data from 6 cycles. So total borrowing increased, as you can see, as a result of the trail loans, both as a result of the trail loans as well as a result of the GBL loans. So these individuals, these households did end up having a larger total borrowing. Okay. The cost of borrowing went down, as you can see, and you can see that it goes down by a lot more for GBL households than for trail households. This is consistent with the idea that here we're also getting these floating borrowers who probably paid higher interest rates in the informal market, whereas here we're only getting connected borrowers. So this is total borrowing, okay, all loans put together. Then you look at non-program loans, which means not the loans given by the microlender through the scheme, but all other borrowing. You can see that doesn't change significantly. So there could be crowding out, but we're not seeing crowding out. Okay? And the cost of borrowing of non-program loans is also not changing as a result of this scheme. And then the effects on the cultivation of potatoes. So why potatoes? Because potatoes are the major high-value cash crop in this area. They are high risk, high return, and the entire project was motivated by the question of, can we increase, can we finance agricultural working capital for cash crops? So that's why the focus on potatoes. We don't find that it changes the probability that either type of borrower cultivates potatoes, probably because most of them already do cultivate potatoes, but it does increase the acreage that they devote to potatoes. For trail borrowers, it increases the amount of land that they lease in order to cultivate potatoes. And you can see it increases significantly the amount of money they spend on cultivating potatoes, so the cost of production. Output increases significantly, and revenue increases as a result of that. And because the revenue has increased by more than the cost of production has, you can see the value added has increased as well. Okay? And you can see that imputed profits are, as a result, increasing as well. And what is also worth noting is that for the group-based lending scheme, none of these things, although they are all positive, none of these are significantly different from zero. Okay. We also look at other crops. You see an increased probability that trail borrowers will cultivate these, increased acreage devoted to these 3 other major crops, but you don't see increases in value added. So the bulk of the effect seems to come from potato cultivation, not from other crops, although the signs are all positive here as well, so that when you look at, sorry, I should have somewhere, maybe it'll come later, but when you look at aggregate farm incomes, oh yeah, it'll come later. You see aggregate farm incomes increased as well. Okay. So now, trying to understand why. How much time do I have? 25 minutes?
Yeah, we end at 12, I mean 1, so, well, we can go a little over.
Okay. Okay.
15 or 20 minutes.
All right. Okay, so now trying to understand why this happens. So the theory says that trail borrowers should have higher productivity than GBL borrowers, which would mean a higher rate of return to an exogenous increase in expenditure on cultivation. So the first thing is to try and see if these borrowers actually are more productive. So this is where you can see that there are positive effects on total farm income as well. We basically use a Cobb-Douglas production function, and we use the treatment status as an instrument for their cultivation costs, because as we saw previously, trail treatment did increase their cultivation costs, and we obtain an estimate of the rate of return for trail borrowers as well as GBL borrowers. And what you see here is that trail borrowers have a much higher rate of return than GBL borrowers. This is for potatoes, so 72% versus 37%. For total farm income, 100% versus only 38%. And this is an alternative way of arriving at these estimates. Sorry, where also we find that there is a significantly high rates of return for trail borrowers, but not for GBL borrowers.
Sujata, what about non-farm income of the GBL?
Doesn't change. So we looked at that as well. I don't have it here, but non-farm.
It would be fair, I think, for the reasons that you described, that your product is much more tailored to agriculture than.
Yes.
It seems like it's fair to look at total household income, not just comparison.
Yeah, I don't think we have a regression with total income, but we have looked at farm income and non-farm income separately, and farm income increases, non-farm income is unaffected.
Yeah, it still seems like a fair comparison.
To look at total aggregate income.
The difference between magnitude and significance.
Okay, yeah, fair. That's fair. I can do that. Yes.
How can you explain the productivity difference? It is because of difference between individual liability and group liability, or it is because of borrower selection?
So in our model, it's because you are part of this network where you benefit from everybody sharing information about production and marketing. And it's those connected borrowers that get chosen into the trail scheme, and the floating don't, whereas in the group-based lending scheme, you get both types. So you also get the productive or the connected, but you also get the floating. So in the group-based lending scheme, you have greater heterogeneity, so that on aggregate, on average, we're not finding an effect. That's, yeah, the model, yeah.
I want to know about the take-up rate of loans in this group.
I will show you at the end. The take-up rate is lower for group-based than for trail. how low? I have a slide here. So it starts off being, yeah, so it falls by the end of 6 cycles, it's about, I guess, a little over 50% for GBL, but it's about 70%, I think, for trail. Okay. Okay. Yes. So the other thing is we want to check, the theory also suggests that trail agents should recommend borrowers who belong to their own network, right? These are the connected borrowers. So we look at 3 alternative definitions of whether you have been in this person's network. So whether you have purchased inputs from this person, from this agent before, whether you've borrowed from the agent before, or whether you've worked for the agent before. And since this is about lending, we think that borrowed may be the most relevant. And you can see that it's not bought from the agent, it's not worked for the agent. It really is whether you've borrowed from the agent before that strongly predicts whether a household is recommended by a trail agent or not. Okay, and this continues to be robust even after we control for caste-based effects, which you might also think are important. The third thing that we think the theory recommends is that the trail agent recommends farmers who have a lower risk of defaulting. Okay? Whereas the group-based loans, probably we are getting both the connected and the floating, therefore both the high risk as well as the low risk borrowers. And we compare the repayment rates between trail and GBL. Here. We control for, we compare informal interest rates that these borrowers used to pay before the loans were given out. And if you just focus on columns 5 and 6, what we seem to be finding is that the borrowers who were recommended by the trail agent, compared to the borrowers who self-selected into the group-based loans, they paid lower interest rates before the scheme entered the villages. Okay. Then loan repayment rates. Okay, now loan repayment rates are different. So these data are cycle level, cycle specific. Should one expect repayment rates to be higher or lower in trail or in versus GBL? Well, in trail we think we're probably selecting borrowers who had higher probability of repayment because they were more connected, they're more likely to be connected. Connected have a higher probability of their project succeeding. Okay? But in group-based lending you have group liability, so you have this insurance that if you are unable to repay your loan, your group member, your group mate could also repay on your behalf. Okay, so it's not clear in what direction it will go, and I think in line with that, you know, in certain cycles, group-based lending had higher repayment rates. In certain cycles, trail had higher repayment rates. But at the end of 6 cycles, you can see this is significantly different, a significantly higher trail repayment rate compared to a group-based lending repayment rate. Okay. Take up, like I said in response to Shu's question, is higher in trail than in group-based lending, and we think this is probably because in group-based lending, these people were required to form groups, they had to meet at regular intervals, and they had these savings requirements, okay? And these impose costs on households, and Albert has work showing that these costs can be quite significant. Whereas in trail, these are individual liability loans with minimal monitoring by the lender. Maybe that's why the take-up rates were always higher. And then in the next slide, I'm going to show you continuation rates, conditional on eligibility. So here, the denominator, when computing a take-up rate, so really how is take-up rate defined? It's just defined as whether you took the loan in this particular cycle divided by whether you were eligible to receive the loan in the first period, in the first cycle. Okay, so once you were in the denominator, you always stay in the denominator. You never get thrown out of the denominator. Whereas in this graph, you get thrown out of the denominator if you are no longer eligible to receive a loan in case you didn't repay your previous loan. Then you would not be eligible to receive it. And so these numbers are different for that reason, and you can see continuation rates are significantly lower at the end of 6 cycles for group-based lending than for trail. Okay, so now other questions. Were there adverse treatment effects on non-farm incomes? Let me show you that. These are all the other types of incomes that we collected data on, and you can see that there are no significant effects either for trail or for GBL. Sensitivity to price fluctuations. So the thing to note here is, like I said at the very beginning, agriculture is a high risk activity. Okay? Now, as we saw, as a result of the trail loans, these individuals, these households, they increased their acreage that they devoted to potatoes, and they spent more money on cultivating potatoes, and their output also increased at the end of this. So the fact that they earned higher revenues and they earned higher value added was a function of the fact that they were selling these potatoes at a high enough price that the revenue was bigger than the cost increase, right? So clearly, the results are going to be sensitive to what price they can sell these potatoes at. Okay, so I'm going to show you this in the next graph. We're doing, in the next picture, in the next chart, we're doing these hypothetical calculations. This is the actual increase in their value added. Imagine instead of selling their crop at the real price at which they sold their crop, everybody sold their potatoes at the average price in their village that prevailed in 2011. How much would they have made? If they sold it at the average price that prevailed in 2012, how much would they have made? As you can see, 2012 prices were much higher than they were in 2011, so they would have made a lot more money. But then we also say, what if they had sold them at 2007 prices or 2008 prices? These are years when prices were relatively low. And you can see in the year, which was the most disastrous year for potato cultivation or potato farmers, because they had all this extra output that they had produced, but the prices ended up being very low. If that had been the prevailing price, then these farmers would have made losses. Okay? So we think it's important to highlight this because we don't want to say that trail is going to give you unambiguously positive effects if you were to implement trail. No, the effects are going to depend on what price these farmers are being able to sell their crop at. Okay, so we think for this reason it's important to have what we also had in the scheme, although it was never triggered, insurance, crop insurance for these farmers, so that if the revenues, in our scheme it was if the revenues fell below the 3-year average in that village, then the repayment amount was reduced. And we think this is probably important for the take-up of these loans, because otherwise take-up could potentially be lower. Okay, now the other question is, this is something I promised I would show as well. Did the trail agent extract these borrower benefits? Now, the trail agent could have extracted these borrower benefits, like I said, in a variety of ways, and we're not able to test all of these. Okay? So in particular, something that we would have liked to test, we didn't have the data. We now have the data, I think, to test that, but we didn't at the time that I made these results. Was if the agent were to say to a borrower that you make me a large lump sum payment, and in return for that I will recommend you to the microlender. That large lump sum payment we would probably not have picked up in our data, the way that our questionnaire was designed at the time. Okay? But what we can show is whether there are other transactions in which manipulations occur. So is there a higher probability that the borrower now buys inputs from the agent? No. Is the share of inputs bought from the agent increasing? No. Does the agent now charge higher prices for inputs? Again, the answer is no. Okay. If anything, for some reason, they charge lower rental rates for power tillers. Are they more likely to sell their output to the agent? No. Does the share of output sold to agent increase? No. Does the output price that they receive change or go down significantly? No. Okay. What we do find is that they are less likely to borrow from the agent, which is probably just the mechanical fact that now this agent has recommended them to receive these trail loans, and so they are less likely to need to borrow from the agent directly. And the share of loans that they receive from the agent go down, but the interest rate that the agent charges them does not change. And then finally, since we have 2 years of data here, so like I said, 6 cycles, each year has 3 cycles, so 2 years of data, we can look at how the results change or are different in each year. And basically, these are the results for trail in year 1 and year 2. You know, this point estimate is a little bit higher than this point estimate, but I wouldn't say that they're significantly different from each other. And then total farm value added, you can see, is significantly higher. So this is potatoes only. This is total farm value added. And you can see that this point estimate is higher than this. And total household income in year 2 does significantly go up, but on average, I don't think it does across the 2 years. So to summarize, what we did is to design and experimentally evaluate microcredit that would finance smallholder agriculture of high-value cash crops, where borrowers were recommended by local intermediaries who were incentivized through commissions that depended on the repayment rates that these borrowers generated, and the loans were individual liability. And our evidence suggests that trail agents successfully recommended productive, low-risk farmers who expanded the cultivation of potatoes and their own incomes, whereas the group-based lending scheme induced eligible farmers to expand cultivation of potatoes as well as incur higher cost of production, but did not generate significant increases in output or farm income. We also find that the trail scheme had weakly superior repayment rates, higher take-up rates, and also, this is something I have not touched upon yet, significantly lower administrative costs. So the other thing that is nice about the trail scheme relative to the GBL scheme is in the group-based lending scheme, the micro lender had to incur significant costs of actually running the scheme, because you have to go into these villages and form these groups. These groups need to, so you need to spend some time creating the groups to start with, then these groups need to meet on a regular basis. There are savings targets that need to be met and all the rest of it, all of which costs a lot of money to the micro lender. Whereas in the trail scheme, the micro lender essentially went into the village in the beginning to kind of to recruit agents, but then once the agents had been recruited, they had recommended the borrowers and the borrowers had been selected, the micro lender did not have to visit the villages as often. Okay, and so the administrative costs were significantly lower.
Are you including that 75% interest payment?
No, not here. No.
That is part of the cost.
That is part of the cost. So that is exactly. So yes. So let me just finish this and then I will talk about that. And also there is no evidence of extraction of benefits by the agent. I think I might, okay. And the borrower benefits came from the expansion of agricultural production, but because it was the expansion of agricultural production, they are sensitive to agricultural price fluctuations. I think that's what I have. Yes, you are right. So 75% of the repayment of the interest payments were given to the agent. Okay, so plus the bonus at the end of 2 years. So the cost of running it are lower, but you do have to make this payment to the agent.
And if you compare that, those total costs?
Despite those total costs, trail is still cheaper, but given that the Reserve Bank of given that the Indian government policy is that microfinance institutions have to borrow from banks at 12% in order to re-loan, they don't break even. So they don't break even on GBL, and they still don't break even on trail. So that is, yes, that is something that continues to be a concern, because if you wanted to make this financially sustainable, GBL is not financially sustainable at all anyway, but trail also still doesn't make it at 75%. But there is this clear trade-off between the commission that you pay to the agents and how much you can induce them to recommend good borrowers or low-risk borrowers to them. There isn't yet, no, but this is exactly what we are going to work on next, which is to see how you can vary the commission. So how much can you vary the commission rate while still maintaining the positive effects that you find? And also, you know, is it monitoring by the agent that is the important thing, or is it this selection by the agent that is the more important channel right? So if borrowers are of a particular type, you're a good borrower, then all I have to do is select you, and then I don't have to worry about you anymore. But if the way to get you to repay the loan is to watch you, so the agent is doing the watching, then that's a continuing cost, right? So these are two very different stories about how this works. So we also want to examine which of these is more important.
Yeah, so it's not clear how much time the agent is spending after making recommendations, even though you say he's not involved in the loan. It doesn't mean he doesn't have an incentive to make sure.
Right. So the thinking here is that this agent is interacting with these borrowers on a fairly continuous basis anyway, because these are people who operate in the village. They are traders or shopkeepers, so they're either selling inputs to these farmers, or they're buying output from these farmers, or they're informal money lenders in these villages. And so relative to a bank coming in, or even a micro lender coming in from outside, these people presumably have lower monitoring costs. So it could still be a gain, but it still remains a question whether that is the channel through which this is working, or it's the selection.
It also seems like the dynamics could change quite a lot if you try to scale this thing up. So if you had an agent recommending a large number of households to a bank in a village, I mean, if he's just recommending 30, but knowing only 10 are going to be picked, then he's not really losing much business. You can probably find 10 additional borrowers and not feel that's crowding. But if he's giving a list of 100 people, which is his whole client base, then he may have second thoughts. It seems like the strategy could change.
When he has to recommend many more. So that's another thing we're going to do, a variation where instead of recommending, no, actually, we're still going to get them to recommend 30, but we're changing what proportion gets selected. So in one, 10 gets selected out of 30, and another 20 gets selected out of 30. So that's a little different from what you're saying. But it does have this effect that he loses more of his clients. Yes, so that's something else empirically that needs to be tested.
It also seems like having a shop owner recommend and having a money lender recommend, the incentives could be quite different, especially as you scale up.
So there I'm not so sure, because there are very few people who are just money lenders by profession. They tend to lend as well as do something else. But also that may vary from context to context. So we're not going to be doing it in West Bengal anymore. We're going to be doing it in a different part of India where land distribution tends to be very different. So it could be that things are different. And this could be one of the things that's different. Yeah.
I want to, could you go through your identification question?
Can I show you your mind? Yeah. Yes. This one?
Yeah.
Yeah.
So you putting these two villages together and run the regression.
Yeah.
So you try to control the selection bias.
What selection bias are we talking about?
I mean those in intra village, some of them be proposed by the intermediate, some are not. So this is.
Yes, yes. So that's right. So that's these people. These are selected by the agent. These people are not selected by the agent. So this is if you're trail control 2. This is if you're trail control 1. This is if you're trail treatment.
And so the X includes the breeder characteristics?
The X includes, no. The X includes land holding of the borrower. It includes a year dummy, and it also includes, we did another intervention orthogonally to this, so it also includes a dummy for that.
Also you have
but we can.
There's no systematic difference, but
we cluster the standard errors at the village level, but no, you're asking if we put in village fixed effects? No, we don't. No, we don't. We could try, but we don't have that many villages. We only have 48. Yes. Hi, yeah.
Thank you for the presentation. So did you quantify the overall benefit to the micro lender between trail and GBL? Because if I'm the microlender, what does it mean in this for me? Like I know the benefits to the farmers, and borrowers, and agents, but
So repayment rates are higher here weekly. Repayment rates are higher, and administrative costs are lower.
So did you quantify that?
We did do a back of the envelope. We did do a back of the envelope calculation, and yes. So if I were a microlender and I had to choose between trail and, ideally I would want to be able to borrow from the bank at a lower interest rate than I am currently borrowing. But if I had a choice between trail and GBL, I would probably do trail, because I am going to lose money in both at the moment, but I'm going to lose less under trail.
But do you have an approximate on the percentage? Is it 5%? The overall cost is 5% lower?
You mean the benefit of doing trail relative to GBL? I don't at the moment, but yeah, no, thank you. Yes.
Is there any reason for assuming that, like within the connected network, they are trying to maximize the aggregate profit of the network? Because it would seem like the lender is trying to act as a discriminating monopolist. The informal lender and basically use his available cash, and trail is giving him.
Yeah, no. So we had in an earlier.
Entire list of eligible borrowers. And he has more creditworthy individuals he could lend to if he had more cash.
Right. So in an earlier version of this paper, there was no network effect. Okay, it was just a standard Ghatak type model of microcredit where there was adverse selection. So borrowers were of different types, and the informal lender had an informational advantage. That was the big innovation relative to Ghatak. So in Ghatak, the microlender just comes in, and that's it. There's nobody in the village who has better information about these people. But in our model, the informal lender had better information. Okay, you can get the same results with that model as you get with the network. So why do we do the network? We do the network because so we had a group of students who went into these villages later. One of my co-authors was leading a team of master's students who were doing their master's thesis on this project or on something related to this project. And they went in and they came back and they told us that there is all this, basically these agents are recommending to you people whom they are connected with, and now that they have these loans, they are more incentivized to help these people to make more money, because if you make more money and if you grow more potatoes and you sell them through me, then I benefit as well. So this was the story that came out of that master's thesis. And so we decided, and one of my other co-authors has also been saying that this is actually what's going on. So we decided to take it seriously, and we wrote down this model because it's a very simple model. It doesn't need adverse selection, it doesn't need moral hazard, and it seems to still explain the findings that we have. But in the paper, you will see in the appendix there is an adverse selection model that also gives you the same findings. There's a moral hazard model that also gives you similar findings. Yes.
Sorry.
Can I say the retreat story into two parts? First part is that trail scheme can help us to select better borrowers, and then this scheme can continually help them to produce more or do better than other borrowers.
Yeah, you could, I suppose. The way it's written down, I think it's all just happening in one shot. These are connected borrowers who are already benefiting from sharing information, and then they happen to get a trail loan. The trail loan is good for them because the cost of credit is lower, because we are giving the loans, or the MFI is giving the loans at 18%, whereas they would on average be paying 20, 21, 25%. So they benefit, basically. People are credit constrained. If you alleviate their credit constraints, then they benefit from that. Yeah, they were already better off, yes, and now they're even better off. So I think to me the big thing here is that GBL does not give you this, right? So the loan terms are the same in terms of, right, 4-month duration, single lump sum repayment, 18% interest rate. All of this is the same, but what is very different is how these loans are given out and how people are selected to receive these loans. In one they self-select, in the other the agent recommends them, and you find these very different effects. So to me the interesting thing is most microcredit is group-based, and we're not finding effects on borrower incomes, but it is possible to get effects on borrower incomes, but you have to change how you select the borrowers.
But now I'm getting confused. I thought you said it was the traditional Grand Union Bank model in the control group.
Modified.
But you're saying it's not weekly repayment.
No, so it was modified to make it still amenable to agriculture, so that you had to pay in a single lump sum. But it was. Sorry, no, because they still had to meet.
Once you form the group.
You still had to meet.
But why? Well, okay. Why did you make them meet?
I think because we were,
weekly,
no, they were saving. They were saving weekly or fortnightly.
Right. It still seems to me that it would be nice in the future to do an intervention where it's purely individual loans to the control group, not traditional GBL. I know you want to attack traditional GBL, but the only difference is one is agent intermediated.
And one is random?
One is, yeah, something, or you could think of other ways
to
pick the borrowers, or you could have group GBL formation, but then give them individual loans. Or, I mean, but to make it, because right now it's really, if you just think the individual loan is much more attractive, and people are going to be more incentivized to keep getting individual loans through the dynamic repayment incentive, et cetera, you can come up with other explanations where they're going to perform better, right? Even without having to necessarily appeal to the agent, the role of the agent, but still we don't have that much direct evidence on what they're doing, right?
Yes, so this is not testing just the effect of the local intermediary. You're right, it's the whole package.
But a lot of what you're saying about even the effect of the network is kind of not directly proven relative to the value of the individual versus the group loan.
Yes, no, so I can't separate out the effects of all of these different things. I totally agree with you. So we could do an individual liability where it's just randomly chosen who in the village gets an individual liability loan versus getting an agent. So everything else could be the same. In one you could get the agent to do it, in the other you could just get farmers to. I mean, there's still going to be some self-selection, but you could randomly choose who gets it. Yes, we could have done that. Or we could do it, yes, yes.
Other questions or comments? Great, well let's thank Sujata for...
Thank you.